Over the last couple months, retired billionaire hedge fund manager Ray Dalio has been saying what I would call the truth. This is what the people at the Federal Reserve, people on Wall Street, PhD economists will not agree to, that the Fed cannot taper, cannot raise interest rates, because the Fed cannot taper a Ponzi scheme. Now, Ray Dalio also deserves some of the blame, and let me explain why. So if you go back and look in 2012, Ray Dalio wrote a beautiful deleveraging white paper. It was around 10 to 13 pages long. I read it back then in 2012, and I think I reread it in 2013. And he actually got private meetings with a lot of Federal Reserve central bankers and also private meetings with people at the European Central Bank back then. And he helped implement a lot of the policy that the Federal Reserve was doing, of the wealth effect, of asset price inflation, of nominal GDP targeting. So he helped cause this wealth disparity. He helped inflate the stock market, the bond market, the real estate markets. That is what he wanted. He wanted nominal GDP targeting. He wanted the Fed to inflate asset prices and to try to create the wealth effect. And now here we are 8 or 9 years later after the beautiful deleveraging, and now he's calling out the Fed. Well, what a lot of people are not aware of also is that back in 2019, when Repo Madness was occurring, the first Repo Madness, is that his former hedge fund, Bridgewater, he's not actively managing the funds there for years now, but they were borrowing heavily in the repo market to leverage up their bond trades. So they were caught with their pants down on the leverage short vol trade, on the risk parity trade, on the basis trade, and they actually were one of the hedge funds, according to my sources, that got a bailout back in 2019 before the pandemic, when the first Repo Madness crisis in 2019 started, because of the amount of leverage that these hedge funds and family offices and portfolio managers at investment banks have on these over-leveraged, overcrowded trades, like the leverage short vol trade, the risk parity trade, and the basis trade. And this is the risk that the Federal Reserve runs if they do hike interest rates, if they do stop buying toxic assets, if they do reduce the amount of QE. A rate hike now could blow up the leverage short volatility trade. The leverage short volatility trade, and I've been covering this for years, when I first heard about it from Christopher Cole of Artemis Capital, the volatility hedge fund manager. A number of years ago, back in I think 2015 or 2016 is when I first heard about it, and when I found Christopher Cole's work. You can go back in the archives and find the videos. Christopher Cole was saying that the leverage short vol trade was almost $1 trillion in size. Well, now here we are 6 or 7 years later, almost 7 years later, and the leverage short vol trade, according to Christopher Cole in his May interview with George Gammon, he said the leverage short vol trade is at least 3 trillion, maybe even 5 trillion in size. So that is how over-leveraged, that is how overcrowded these hedge funds, these family offices, these bond portfolio managers have borrowed funds to leverage up on these trades. So if the Fed does decide that they want to taper, if the Fed does decide that they want to hike interest rates a quarter point or a couple quarter points, the Fed is playing with fire. The Fed is risking lots of long-term capital managements and similar bailouts of hedge funds to what they had to do during the Repo Madness crisis in 2019. There was a lot of hedge fund bailouts. The Fed's balance sheet, official balance sheet, grew by $1 trillion back then in only a couple months. And then also how hedge funds were bailed out in February and March of 2020 with similar problems. Credit markets and bond markets all over the world in February and March of 2020 went no bid. So the Fed, for a while, had to backstop, had to guarantee all credit markets and bond markets all over the world. That is how messed up things are. That is how over-leveraged and overcrowded these trades are. And a lot of these hedge funds and family offices have overborrowed in repo. So while the mainstream financial media and PhD economists and people at the Federal Reserve are looking at the amount of reverse repo, which was over $1 trillion in a single day last week, I'm still looking about how the Fed's official balance sheet is still growing, the European Central Bank's balance sheet is still growing, and how over the last 2.5 years, the Fed's official balance sheet since early 2019, the Fed's official balance sheet has grown from around 3 trillion to 8.2 trillion. So you cannot taper this Ponzi scheme because of how over-leveraged and how overcrowded so many of these big income-generating, risky income-generating trades that professional money managers have put on, like leverage short vol, the risk parity trade, the basis trade, so many other trades. And that is the risk that the Federal Reserve runs if they do hike rates at this point. So there's going to be either covert or overt yield curve control. The Fed can allow interest rates to rise a little bit within a range, and that will temporarily bring more interest from foreigners back into U.S. Treasuries. However, the U.S. federal government cannot afford much higher interest rates. The U.S. federal government cannot afford to pay 2%, 3%, 4% interest rates on the rapidly growing national debt, especially as Congress talks about spending trillions more. So Ray Dalio is telling the truth now. The Fed can't really tighten. The Fed can't raise interest rates without blowing up hedge funds. The Fed cannot taper this Ponzi without toxic assets melting down rapidly, and then the Fed having to reverse course to a 180 quickly. However, Ray Dalio benefited heavily over the last 7 or 8 years from writing his white papers like the beautiful deleveraging and getting the Cantillon effect, getting asset price inflation in stocks, bonds, real estate. So Ray Dalio has reversed course on what he is suggesting, but he's already increased his net worth massively. So he's already benefited from policies he helped suggest back in 2011, 2012, 2013 with his beautiful, quote unquote, beautiful deleveraging, which was not actually deleveraging at all. There was no deleveraging. Corporations borrowed enormously more for share buybacks. Corporate debt exploded over the last 10 years in the US. Government debt exploded in the US too. So there was no beautiful deleveraging. It was all marketing. So Ray Dalio's net worth could grow enormously through the Cantillon effect and asset price inflation that the PhD economists and people on Wall Street and people at the Federal Reserve said was no inflation. And the deflationistas said that there was no inflation. Finally, if you like content like this and want to help keep content like this free so it doesn't all end up behind a paywall, or you want far more in-depth content, research, financial education, and analysis than I provide in these short little free videos, there is 25 new articles out in the last 10 weeks behind the paywall over on my Patreon for only $5 a month, the cost of a Starbucks cup of coffee. And now there's over 180 articles, charts, and audio podcasts behind the paywall on a lot of interesting topics about global macro companies and sectors. The last 3 or 4 weeks, there is a lot of articles about gold miners and which ones have had their costs rise a lot, which ones have been able to keep their costs under control. So I'm comparing and contrasting different ones, along with a precious metal royalty and streaming company that doesn't have to worry about higher labor costs or higher oil prices. They just increased their dividends by 50% last week. So if you want to learn more about that, it is only $5 a month. You can always cancel. I think it is one of the best deals out there, and no one in this space charges less than me for premium content, trying to give everyone really quality information at an affordable price. So if I could wrap up this short little video in about a minute, Ray Dalio has already benefited from his policy suggestions that the Federal Reserve and the European Central Bank over the last 8 to 10 years listened to him. He got private meetings with them. He disclosed this in his book Principles. If you go back and read it, he also disclosed in his book Principles that he got insider Chinese deals. And that comes at a big cost, especially in China, and how he has to go along with what the Chinese Communist Party has to say. But now Ray Dalio is being honest. He's admitting that the Fed can't tighten. He's going against the conventional Wall Street wisdom, what the Federal Reserve Bank, PhD economists, and money managers on Wall Street are saying about how the Fed has to tighten, about how the Fed has to hike rates. Ray Dalio knows because back in 2019, his hedge fund, Bridgewater, and he wasn't managing the portfolios back then, I believe. I believe he had already retired, but it's pretty well known throughout the financial industry that large hedge funds like Bridgewater had to have bailouts, secret bailouts, similar to long-term capital management. As the Repo Madness crisis was blowing up, the Federal Reserve bought at least $1 trillion of toxic sausage to bail out hedge funds that were caught with their pants down when the Fed was still tapering and raising interest rates. And that's what helped fuel the Repo Madness crisis, because hedge funds like Bridgewater had went and borrowed in the repo market to leverage up their bond trades on the risk parity trade, the basis trade, and then also other risky trades like the leverage short volatility trade. So there will be more hedge funds blowing up in the near future on leverage bond trades or the leverage short vol trade if the Fed does hike rates by 1 or 2 quarter point hikes, or does a meaningful taper of asset, and I'm using air quote, asset purchases.